Welcome to this explainer. Ever wonder what actually happens when you deposit your paycheck? Let's find out. You probably picture your cash just sitting safely inside a giant Scrooge McDuck-style bank vault, right?
Well, reality is way wilder. Your deposited money gets instantly blasted out to fuel the entire financial system. It's called fractional reserve banking. This whole system completely relies on us not withdrawing everything at once.
See, banks only keep a tiny fraction, that massive remaining chunk, they loan it right back out. But here's the crazy part. When someone gets a loan, banks don't hand over stacks of existing cash. Instead, they literally create brand new digital money just by typing numbers into the borrower's account.
This sparks a chain reaction. Borrowed money gets spent, deposited elsewhere, and then loaned out all over again.
As that second bank lends out part of the new deposit, the entire circulating money supply actually balloons.
This invisible cycle hums perfectly because modern money is mostly just digital records moving electronically, not physical cash.
This massive shift makes modern money creation infinitely faster and way more interconnected than in past centuries. Meanwhile, banks profit from loan interest that covers their operating costs and buffers against inevitable financial risks. So, if commercial banks constantly create digital money, who exactly regulates this massive overheating financial engine? Enter central banks. They manage national currencies and act as the ultimate referees for the whole financial system. The crucial takeaway here? Central bank policies directly shape how easily this money flows through our society. When functioning well, this bank-created money fuels economic growth, letting businesses expand and families buy new homes. But there's a huge catch. While funding massive investment, excessive lending can easily trigger severe financial instability. If banks approve too many risky loans and borrowers can't repay, the entire financial system rapidly weakens. Throughout history, we've seen how quickly localized lending problems spread like wildfire, devastating entire national economies. Ultimately, this incredibly complex, interconnected system balances entirely on one fragile foundation. It relies on immense public trust. We accept these glowing digital balances as real money purely because we believe banks will actually honor them. Which brilliantly illustrates the ultimate risk. If that collective public trust ever vanishes, what happens to our money?